Berkshire Hathaway recently held their annual shareholders meeting for 2021, and it was a good sight to see Warren Buffett and his old partner Charlie Munger together again. In this shareholders meeting, we got to hear a lot of interesting insights from these two investing legends, especially during these complex economic circumstances, with a quick recession and now a blooming economy. In this video, we are going to mainly focus on some interesting highlights of the 10Q report of Berkshire Hathaway. And we will also look at why Buffett has done some of the interesting moves during this quarter. In the consolidated statements of earnings in the 10Q report of Berkshire Hathaway for 2021, we can see that revenues from most segments have increased year on year. Insurance premiums earned, sales and services have increased. However, interest and dividend income have decreased. We saw before that Warren Buffett has significantly decreased his holdings in banks, which could explain the lower dividend return, but also Berkshire Hathaway's main insurance company, Geico, could have realized lower interest margin due to lower interest rates. Berkshire Hathaway also have investments in treasury bills, which are earning lower returns, again due to lower interest rates. Another interesting change to note is that revenues from the energy segment has increased substantially year to year, perhaps signaling that the energy sector is gaining more momentum because of the global movement to a more clean energy, low pollution, zero carbon type of energy production. More significantly, as can be seen in this slide, is that Berkshire Hathaway net earnings came in at a little bit above $11 billion, compared to last year's loss of $49 billion. Now keep in mind that a substantial amount of these $49 billion loss is printed as unrealized losses in the market. That is when the market fell in Q1 2020, and according to GAAP accounting, companies must print those losses in the earnings statement. Of course, these losses aren't actual losses since Berkshire Hathaway didn't sell their stock equity at the market crash. However, at Q1 2020, Warren Buffett did sell some equities such as the major positions in American airline companies. We also saw Warren Buffett moving out of financials as well in 2020 by reducing partly or completely in holdings such as JP Morgan Chase, Goldman Sachs, and Wells Fargo. If we take a look at retained earnings, which is one of Warren Buffett's favorite metrics to analyze when valuing companies, we see that from 2019 December to 2020 March, Berkshire Hathaway reported a reduction in retained earnings. However, from the first quarter of 2020 until today, the first quarter of 2021, retained earnings are standing at approximately $456 billion, which is a substantial increase in 1 year. Moving on to the cash flow statement, we can dissect a couple of interesting moves here from Berkshire Hathaway. First off, many investors such as Warren Buffett and Ray Dalio has constantly informed investors that investing in bonds or other debt instruments such as treasury bills is not a good investment in this economic phase. We can see here that Warren Buffett has redeemed a lot of bonds and T-bills worth approximately $37 billion, compared to last year $3.7 billion. Which I guess is a proper move to make in this low interest environment with high inflation pressures. Also, Warren Buffett has thus far in 2021 engaged in stock buybacks worth about $6.6 billion. Now, stock buybacks is one of Warren Buffett's more favorite way of rewarding his shareholders, and he prefers stock buybacks over dividend payout. Stock buybacks is something Buffett has engaged in 2020 as well, and last year, Buffett acquired approximately $24.7 billion in Berkshire shares, which makes sense in a period of market sell-offs. As it stands today, we can see that cash and cash equivalents at the end of the first quarter stands pretty high compared to last year, so Buffett is actually holding on to cash, which is quite an interesting move. On one hand, investors are screaming that holding on to cash or bonds even is a bad investment move. On the other hand, Warren Buffett is holding on to cash. So could it be that Warren sees the market being way too overvalued and is holding on to cash and wait for a correction or even a market downfall? This is a move that Warren Buffett has done historically, where he sits on a big pile of cash, even for years, and when prices are right, he strikes hard. An interesting key statement from Warren Buffett is that the average person is better off investing in a broad-based index fund focused on such as the S&P 500.
I recommend the S&P 500 index fund, and have for a long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And
so Warren Buffett states that the average person should not pick his or her own stocks and is much better off investing in an index fund. However, Charlie Munger firmly states that he is more comfortable with his Berkshire holding over the S&P 500 over the long run. Berkshire Hathaway also announced that the successor to Warren Buffett will be Greg Abel. Greg Abel is the current CEO of Berkshire Hathaway Energy Business and also the vice chairman of Berkshire Hathaway. So that's it for the video, guys. This was one of the more interesting annual meeting of Berkshire Hathaway, and I encourage you to watch the whole annual meeting for interesting investment topics. If you enjoyed the video, do consider to give a like and subscribe for more investing related content. Take care.